Is it time for Social Security? If you have watched any of the videos in this library, you know that they are all devoted to helping you maximize all that you've got coming from your Social Security. But it's not only about getting the highest lifetime benefit possible. To truly maximize benefits, it is also important to understand the potential impact of taxes and what is often referred to as the Social Security tax torpedo. It has gotten this name because people new to Social Security are often surprised to learn that their benefits are subject to income taxes. But here's an even greater surprise. Two people could have exactly the same Social Security income, as well as the same total retirement income, yet one person could end up paying a lot more in taxes on his Social Security than the other. When it comes to the taxation of benefits, it's not just how much income you have, it is also the source of retirement income that can determine the amount of taxes you'll pay. This can mean that any time a withdrawal is taken from a 401k, traditional IRA, Roth IRA, or any other source, the potential taxation of Social Security benefits can be impacted in either a negative, taxation is increased, or perhaps a positive, taxation is reduced manner. Consider the example of Bert and Barry, brothers who are surprisingly similar in just about every way, except for the amount of taxes they pay on their Social Security benefits. They're both married, each has accumulated a good amount in their retirement accounts, and once they retired, they each received identical Social Security benefit checks. Unfortunately, Barry's check came with an unpleasant surprise. 85% of his benefits were taxable, while Bert's benefits were 100% income tax-free. And the difference in this tax treatment all came down to the source of each of their other retirement income. Here's what I mean. Barry and his spouse have a combined annual Social Security retirement benefit of $28,000. In addition, they have a traditional tax-deferred IRA from which they withdraw another $30,000 annually. We have chosen to illustrate these amounts specifically because this amount of income, coming from these two sources, places Barry and his spouse at the top threshold for the purpose of calculating the portion of their Social Security retirement benefits that must be reported as taxable income. This assumes that Barry and his spouse file a joint income tax return. Note that this threshold is even lower for single taxpayers. Understand that for the purpose of this example, we are ignoring any deductions, exemptions, or other factors that might reduce their taxable income. When considering the income of the Social Security tax torpedo, keep in mind that its full force is felt the most on any income that exceeds this top threshold. In other words, any amount above the threshold potentially gets hit the hardest by taxation. And the following tax examples only apply to the amounts of income over this top threshold. The problem is that if Barry limits withdrawals from his IRA to just $30,000, that along with his Social Security really only allows he and his spouse to just pay their bills and other basic living expenses. There isn't a lot left over to pursue their hobbies and do the other things he had hoped to be able to do once retired. He does have sufficient funds in his IRA that he had always planned to use so that he and his spouse could have some fun. The problem is the Social Security tax torpedo. Because of it, the more he withdraws from his IRA, the greater the portion of his Social Security income is lost to taxes. For example, if Barry withdraws just one additional dollar from his IRA, that places him $1 above the top threshold for Social Security taxation. That single dollar impacts his taxable income in two negative ways. First, since the source of the withdrawal was a tax-deferred IRA, the entire dollar is considered taxable income. This doesn't come as a surprise to Barry. He has always known that one day he would have to pay taxes on the money he withdrew from his IRA, but he was totally unprepared for the other impact. Because that dollar he takes from his IRA causes him to exceed the top threshold for calculating taxable Social Security. This additional IRA withdrawal also causes one of his Social Security dollars to be 85% taxable. Think about this for a moment. Barry only withdraws one additional dollar, but because the source is a traditional tax-deferred IRA, it actually creates $1.85 of additional taxable income. Assuming Barry is taxed at a marginal rate of 12%, his additional income tax would amount to 22 cents. $1.85 times 12% equals 0.22. Again, he only withdrew one additional dollar, and even though his marginal tax rate is only 12%, that single dollar withdrawal actually creates 22 cents in total additional tax. If his marginal tax rate was a higher 22% instead of 12%, the total additional tax from that single dollar IRA withdrawal would be an even higher 40 cents. One additional dollar withdrawn from this IRA creates a total of 40 cents of additional taxes. Now, let's consider Bert's situation. Remember, we said that both Bert and Barry have exactly the same Social Security benefit of $28,000 and exactly the same total income, but none of Bert's Social Security is included as taxable income. How's this possible? Essentially, it's because of the source of Bert's other income. You see, instead of a traditional IRA, Bert has a Roth IRA he can tap to supplement his Social Security benefit. Qualified Roth IRA distributions are entirely free of income tax. And those withdrawals are not added to the Social Security tax threshold calculations. Depending on a person's specific circumstances, this might reduce or even eliminate Social Security taxation. Because of their Roth IRA, you might say that Bert and his wife are in tax-free happy land. Now, it is only fair to say that Bert never received a tax deduction when he made contributions to his Roth IRA, as he would have if he had instead contributed to a traditional tax-deferred IRA. But now that he is retired, qualified distributions from his Roth IRA might increase his after-tax spendable income. It is important to say that Roth IRAs are just one example of a retirement asset that can provide favorable results with regards to Social Security taxation and income taxes in general. When it comes to retirement income, it's what you have left to spend after you pay taxes that is all that really matters. And this is exactly why it is important to understand the potential impact of Social Security taxation. That's it for this lesson. Thanks for watching. See you in another lesson.